What's up, team? Happy Friday. Hey, it's Friday. All right. Wait a minute. If you work in real estate, it don't matter, does it? 7-day week business we're in, but still nice. Fridays still feel good. Today especially good. We're going to take a look at a few different things today, a couple updates, some stats. We're going to look at mortgage bonds. We're going to look at the real estate market, some data there. We're going to look at implications of a wartime scenario that we're in right now. We're going to actually look at properties. We're going to look at rates. I'm going to run through things pretty quickly here. Still have stuff to do today. Got a lot of loans locked today. Derek Evans here, VA Home Loan Specialist in MLS. 155010. Call, text, email me if you want to buy or refi. That's what I'm here for. No points, no fees, low rates. You know the thing. All right. So let's take a look first at mortgage bonds. So today, up 23 basis points. Decent to have an update today. I got multiple loans locked today. Where's this thing? There we go. Multiple loans locked today. Rates were reflecting better earlier in the day today than it really showed. I mean, at one point we were up, let's see, what are we at now? 1.11. We were up like 40 or 50 basis points today at one point, like up here at the top. So it seems like we're kind of trying to establish a new range here, which is cool. Or maybe a new trend. Could it be? Is that possible? Could we really start an uptrend here? It's crazy. I don't think so. I thought we would get rejection right here, and we did. Remember, we want to see mortgage bond prices going up. That will mean lower mortgage rates, and that's good, I think. Certainly good for me. Certainly good for anyone who wants to buy or refi. So that's what we're actually seeing right now. Essentially, the beginnings of what could be an uptrend. Huh? How? Well, again, that it goes in lockstep with the wartime scenario, right? The fleeing of money. You're seeing the crypto is absolutely fleeced today. Let's see here, just fleeced 6, 7, 4, 7, 8% down. Oil up to $115. We've been talking about the oil trade. We're gonna talk about that in another video. It's not quite time yet. I have some limit orders in on some options there that won't get hit for a little while, but it's not quite time for the oil trade. Gold almost $2,000. How about that? You can see bonds here today just down a little bit, and markets they're down. Stock market was down. Pre-market or the futures currently down as well. Big time down on the Nasdaq futures. Whoa. But it's Friday. It's late in the day. We can't look at that too much at this point. What we can look at though is the beginnings of a decent looking chart here on mortgage bonds. These locks we did today were all refinances. So a lot of people taking advantage. It was a great time. This could be, who knows? Like today could have been the last good day to lock a refi. Who knows? This thing could easily go the other direction. The most recent candle here is not super bullish. You got that wick at the top. That usually means, hey, we're moving down. But even if we come back down into this old range here, this is okay. We just don't want to see this get violated. We don't want to see it go below that. So right now, good shape, being optimistic, looking pretty good for mortgage bonds. Let's take a look at some real estate data. Okay. So we got some good news on the front. How about that? Happy Friday. All right. Now, Altos Research, as you'll see here, this is market data for realtors. And although I'm not a realtor, as you know, I do have a real estate license. You have to have one if you're a mortgage broker. Very interesting stuff here. For this week, the median price, list price in San Diego, over $1 million, almost $1.2 million. Isn't that wild? Here's what's interesting. We've been watching the market action index kind of peel back and soften up slowly. We even got down to the low 80s, I believe, at one point there. Now back up to 89. So we're at 88 the previous month. Now back up to 89. Super duper crazy strong sellers market. Here's what's real interesting. And we're going to take a look at a couple of these stats in great detail, but I love the summary right here in the corner on this homepage. And by the way, when you go to Altos Research, you can look at condos. You can get the data for condos. I like to look at detached. I feel like that tells me a little bit more about the market. You can look up your specific zip code and get the data there. Really, really useful stuff. So you always want to look at the same report. If you're going to try to analyze a market and see what's going on, you have to look at the same report every time so that you can get a feel for it. Median list price here, you can see that's going up. Median price of new listings, you see that's also going up. Price per square foot, we're going to look at this in detail. But look at that. Just back in November, 4 months ago, 623 a square foot. Now 691. Anyone got quick math on that? I can tell you it's more than 10%. I tell you that right now. Maybe not by a lot, but it's 10% plus. So price per square foot, we're going to look closely at that. That is the number one metric to follow for real estate values. Average days on market. Also notice this declining now. Remember, we were looking at this and going, oh, look at these days on market at the end of the year, the beginning of the year, we got to 50 days. Back down to 37. That's declining. You can see the market heating up. This is wrong. I don't know what's happening here. Some math is off. There's no way a median can ever be 0, PS, unless all are 0. Nothing can be a median of 0. Price decreases. Look at this. This is really interesting. In November, we had 26.5% of listings with a price decrease. That's a lot. That's more than 1 in 4. Now down to 11%, 1 in 10. So this right here is showing you the demand. There's just so much demand, guys. So little inventory, which is the other metric we're going to take a close look at. Price increases are also down, not necessary because they're all getting escrow. Relisted, also way down. Look at that falling off a cliff. In November, we were 18%. Now it's down to 10. So just falling off a cliff. Relisting, not necessary if they're selling like hotcakes, right? And look at inventory. Back in November, 418 homes available here, and now down to 251. Inventory continues to decline. We'll look at that in more detail. Also, look at this, median rent. So all of these factors are contributing to what we're seeing. Median rent has gone from $32.50 in mid-November to $34.88 here in February, or at the end of February, as of at the end of February. That is another big, like a 7% increase in 4 months. In 4 months. And it's not surprising to anyone, is it? So let's take a closer look. That just, so if you're wondering, why is the market so hot? Why are properties flying so quickly? Why is all this happening? Shouldn't everyone be worried about war? Shouldn't everyone be worried about us getting nuked by Russia any minute? Shouldn't everyone be concerned about the stock market dying? Shouldn't everyone be worried about these bonds that are all worthless? The market speaks. We have to listen. That was the last video. Why do we do that video? Because the market told us back in COVID, remember? By the way, it's always good to refresh yourself. Look at the real estate value graph, median sales price for houses sold in the United States going back to 1963. That's what it looks like. Okay, that's not a log graph. That's a linear graph. Probably should be represented by a log graph. But either way, what we found, what we learned, because this was COVID right here, right? And look what happened in real estate since then. When there is the expectation, when there is heavy fear, when there is grave concern, money flies toward real estate. And that's exactly what's happening right now. The exact same thing's happening. Look at price per square foot. We have once again separated from this 90-day average. So the solid line is the 90-day average. The dotted line is the 7-day average. And that's why it moves a little bit more. And the 90-day, the solid line, is more smooth. Let's just take a step back and look at that. Does that look like spooky? Does that look crashy? It doesn't. It doesn't at all. That looks like super sustainable growth in value. That's what that looks like. There's nothing like parabolic about that. That is super smooth and slow. It's exactly what you want to see if you're long real estate, and we sure hope you are. Then you like to see this. This is very reassuring. If you're betting on real estate, in other words, you're about to buy a house, you also want to see this. Now, we have noticed when the 7-day average here, price per square foot, escapes high from the 90-day average, it does tend to return. We notice that's happened multiple times here. It gets away from it, and then it returns. Gets away from it, gets away from it, returns. We're away from it right now. We're away from it by about, let's see, was that $28 a square foot? So, maybe things will settle a little. Maybe. It's also been multiple fake outs too, right here. Fake out, fake out. If you were waiting down here, so you don't want to follow this graph necessarily. If you were waiting right here going, oh, I can get it for 610. I'll just wait till it hits the 90-day. Didn't hit the 90-day until it was 655 or 646. So you would have paid 5% too much. So I'm not saying you should trade real estate ever. Real estate is either an investment or a place to live or both. Really, it's a hedge against your housing expense. So that's a really important piece of data to look at. Now the inventory, you're going to see the exact opposite here. Decreasing. And decreasing in, again, not a parabolic way, but in a very methodical, smooth ebb and flow. You can see it goes up. Okay, inventory, we get a little inventory, and then what happens? Boom, buyers come in and just snatch it up. Just snatch it up right away. Look at the separation here in the 7-day average. That just shows you how quickly buyers came in and snagged that inventory. Just snatched it up. And, then, okay, all right, we get a little bit of inventory, and then buyers come in and they snatch it up. And that we've been seeing that cycle happen now for years. It's just getting more exaggerated now because there's less inventory available. And every single metric and every single data point that I'm tracking is telling me there's going to be even less inventory. Less and less and less. We are entering the San Francisco phase, as I like to call it. War is definitely causing problems with a few things. You see here, average gas price has now surged the highest point since 2012. When we look at oil, so these kinds of things, I want to tell you about this because you're going to hear a lot of fear mongering. You're going to hear a lot of scary type stories and stuff that are going to have to do with gas running out, are going to have to do with, prices of things going up a lot. Notice something about oil, and this is just, everyone should just know this. It's the reason why it's the one thing that I don't mind a swing trade, although I don't really trade much anymore. If we go and we look at, let's just look at oil futures. Can we take a look and see what happens here? It tends to get over exaggerated. And there's a number of reasons for this. We got to $140. A lot of people actually blame this on Obama, but that was on Bush's watch, March 2008. That was on Bush. So we went from, it went crazy. When he took office, it was in the 20s and it got to 140. So that's on Bush. These few spikes over here, you could say, okay, those might be on Obama, but this big one here to 140, if you guys remember that in 2008, when it was just absolutely insane. Yeah, that one's on Bush. But anyhow, it doesn't matter who the president was. Look at what happens. You have this big spike. Why does that happen? 2 reasons. Number one, there's obviously a limited supply of this. And so there's certain companies that need oil, like the airlines and so forth. They have to hedge. They hedge so they buy it. And when things start to go crazy like that, they actually try to get out in front of it a little bit too much. And it's understandable why. But also the reason why the plummet takes place, you notice the plummeting that happens almost immediately thereafter, it's because similarly to like gold, if you're getting $115 a barrel like they are right now, if you are a producer of oil, you are going to get as much of it off the shelf as you can. So when you're producing oil, you're producing it, and then you're shelving some of it because you're trying to sell it at the best time, right? Well, when it spikes up like that, you're just, everything that's on the shelf, everything that you make, get it out in the market. Sell it. Sell it. Because you're making a fortune at this much per barrel. So that's why you'll see, whenever it spikes up, it comes down pretty harshly, pretty quickly, because the production and, the people who are producing and who have the stockpiles, they'll bring it to the market at those prices. The same thing happens with gold and other things that are similar commodities. So, it's, while we may see a spike and it may be brutal for a few months, just know that historically, you look back, you see these spikes, there's always relief around the corner. Don't make any long-term decisions based on these short-term circumstances is what I'm telling you, okay? But this is part of the implication. It's inflation. It's a wartime scenario. We have a crazy conflict going on over in Eastern Europe between Russia and Ukraine. And it doesn't look good. It looks really bad. So fear will be abundant. And what I'm telling you is try to stay smooth and calm. Don't FOMO into anything. Don't FOMO out of anything. Just have your plan and stick to it, okay? Oh yeah, I want to show you guys this. So I was looking at properties today. So we're going to look at properties, and I'm going to pull up some interest rates, and we're going to call it a day, okay? Looking at properties, and what I'm looking at here is this is $700K or less in San Diego County, mostly, although I did go up to Riverside and check that out a little bit. I was looking at these, And, I'm on a detached home, 3 bedrooms. Okay. I didn't put a pool or anything like that. Here's a new one 6 hours ago. This one wasn't up here this morning when I pulled this up. Little Esco single story. Yard, she shed. All right. $699. So under 700, there's less and less. I mean, look at the inventory. Look at this. Isn't that insane? San Diego's a big place. I mean, big, from a demographic standpoint, also big from a geographic standpoint. And look at this. Wild. Just wild how little there is. I did find one that I thought was worth mentioning. This one here in Spring Valley. Let's see who has this listing. Lorinda, Market Guard, and Scott Vinson. There you go. What's up, Scott? So this listing here is, I would call this like a diamond in the rough, or I don't know, the market's missed it probably. It's open tomorrow. It's $675. It's really, really nice. Look at this thing. I got to show you this. There's a lot of people who are looking for homes out there. It's pretty unassuming until you get to the backyard. Look at this backyard. Look at that. I mean, when you're talking about a great investment in San Diego, buy a house with a yard like this. Because I guarantee you one thing, there's no way they'll ever build them with that big a yard ever again. They won't. It's not going to happen. So, do you need to have a little retaining wall over here because you got this back here? Yeah, sure. But look at this space. I mean, could you build an ADU here? You could. You could also have a football practice here. I mean, that's what I'm talking about. So this one should be a hot home. It's not. So if you're looking at under 700 detached, it's also a 4-bedroom PS. I would definitely, and it has AC, so no HOA. This one is a clear diamond in the rough. So take a look at this one. It's 2409 Wagon Wheel Court. But I was looking here, and and then you go up and you say, okay, well, there's not much inventory down here. Let's take a look up. Let's run up to Fallbrook and Temecula and see what we can see up here. And there is more inventory up there. And this is in these homes, you're getting more bang for your buck, and that's the reason why a lot of people are going that direction. And I completely understand that. But look at how much more inventory there is. Just like immediately, we have to zoom in now. Redfin's like, hey, we have too many results here, right? We didn't have to zoom in when we were down in Escondido in North San Diego County, did we? Because there wasn't enough properties. So that just kind of shows you how little there is. And if you're looking for a home right now, you already know this. But, it's nice to get sort of a zoomed out visualization of it as well to go, okay, wow. So these are the factors that are really, really playing in right now to what's going on. Let's take a look at interest rates. I mentioned locked a bunch of loans today. It was a really, really good day. We had timed 2 of them perfectly. So sweet. It was even 0.25% lower than what I had quoted. Let's take a look and just see where are interest rates. We're going to look at conventional, FHA, VA, then we're going to call it a day. All right. But I want you to know where this is. Now, heading into the weekend, this is an important note because it's 4:14 p.m. on a Friday. I beat the last couple of loans that I locked. I was able to beat the weekend hedge. And so, at the end of the day on a Friday, a lot of times you'll see banks, they'll hedge the weekend and they'll adjust pricing higher just because, it's getting late in the day and they may not have time to get their hedge in on the lock. So they make an adjustment for that. Okay. So, but needless to say, I'd say these rates that we're going to see are pretty safe for what we can expect on Monday. Of course, anything could happen over the weekend. So let's go conventional here. We're going to look at purchase rates. All right. Conventional, we're going to do high balance to begin with. So let's do 900,000. If you have a scenario you want me to do, just type it in the comments or whatever, and I'll do a specific scenario too. Based on amount here, let's do minimum down payment. How about that? Age 55. We like to use 780 credit here, keep it fair each time. And although there is less and less differences in credit, especially with FHA and VA, for conventional, it sure does matter. Look at Loan Depot Wholesale getting into the mix. Nothing against Loan Depot at all. Actually, really, really good company. 4.125. I probably wouldn't go there with it though. If we need on a purchase for a quick close, I'd probably come to JMac. Either way, you're getting 4 1/8. 4.125 is what you're looking at there. Small lender credit in both cases. Hey, not too bad. That's high balance PS. So let's go to conforming and see what that looks like. So we'll call it, let's see here. I need to probably do 650. And of course, this is making no assumptions. I'm just showing you what rates would be if you were to qualify, income qualify for these and credit qualify for these scenarios, just so you can see kind of what things look like. All right, what's 5% of this? It is 32.5, right? So 625, 500. It's a good mental math. No. 622. So close. Well, my mental math game sucks. I was trying to get it exactly right. Clearly, I need help. What is 5%? My goodness. All right. All right, this is conforming balance. So conforming balance under 647,200. There's been a big gap lately on conventional loans between the high balance and the conforming balance. Here you go. Look at that. 3.75. So 4.125 to 3.75. So if you're in that echelon, I've been doing this with a lot of refis lately where people are doing cash out or something like that. And they're like, well, I want the loan amount to be 670. How about 647,200? You know, keep it in here. You get a much lower rate. A lot of times it's worth it for people unless they really need that cash to do this. So that's just something to keep in mind. 3.75 here equates to a 1276 rebate, which will cover the tax service fee of $75. There's no lender fees here, no points. 3.75%. So this isn't bad. So, but I'm saying there's hedge in here. They were better a little bit earlier today, but this is good to know. All right, let's do VA next. I am a VA home loan specialist. PS, call, text if you want to buy a refi. Send me an email as well. All my information's on this channel. Let's check out VA. Let's go. I'm going to do a purchase. Let's do high balance. High balance first. Oops. I'm going to say 700,000. Why not? What's going on here? 700,000, 780. No lender fees. Let's do this. Alrighty then. 3.25. Wow, that is not too shabby. Look at Flagstar coming through. Flagstar Wholesale in the game, just destroying everybody. What a deal. That I have to circle wagons on a couple of deals based on this. Goodness gracious, where'd this come from? This is like out of nowhere. Flagstar. Wow. Okay. Noted. This is why you have to run through rates. See, I would do this myself anyway. That's why I'm happy to do it here, you know, live on the show, just because I'm going to do it anyway. I have to study this. People don't expect me to know exactly what the rates are, but I definitely get the calls, the texts, the messages. Hey, what are rates looking like today? All right, so we go the conforming balance under 647,200 here on the VA purchase, 299. And again, look at that. Just look at the difference. CMG here is 50 bips better than Flagstar, who was just smoking everybody on the high balance. That's why being a broker right there. That's it. Right there. I'm telling you, that is it. That is why, at the end of the day, I had to be a broker. As you can see, different circumstances mean different banks are going to be best. We saw in the last one, the high balance VA, Flagstar was crushing everybody. Now on this one, CMG is crushing everybody. Because not only is it $299, it's $299 with $2,600 credit. That is just smoking. All right. Good to know, good to know, good to know. And these things change all the time. So I can't just like take that to the memory bank forever. Let's look at FHA. Okay, so we're going to compare the high balance VA, 3.25, conforming balance, 2.99. Let's see how FHA stacks up here, because usually FHA pretty similar to VA. Although I've seen some decoupling here lately on that. And all right. So same deal. Now we have two different options at 2.99. CMG still in there with a nice big lender credit. And then let's go to, let's call it what? This will be easier math for me. See if I can get it right this time. 800,000. All right, so what's 3.5% of 800,000? Well, 3% would be 24. So 28. So then 772. Nice. Okay. So here we go. High balance FHA. Will it be 3.25? 3 1/8? I'll be damn. And it's Flagstar again. So what if we don't like Flagstar? Okay, then PennyMax in there. 3 1/8. There it is. Look at this weird pricing. This is one of the things that started happening that just tells you, when I tell you that the bond market is broken, please understand that I'm not just talking out of my arse. Look at this. Does that make any sense? You can get a 3 1/8 and they'll pay you $1,000, but if you want 3 1/4, which is a worse rate, you have to pay $79. You see this? This just shows you when things are broken, that's what it looks like. Bond market is broken. No matter what we think, no matter what we hope for, it's broken. This is just one of the very small remnants of that, but evidence nonetheless. So FHA high balance, actually better than VA high balance. It was the opposite 2 days ago. Okay. So this is why keeping up with this stuff is so important, why being a broker is so helpful to be able to capture the best possible deals in these scenarios. Team, I hope you have an awesome weekend. I hope you know I'm here for you if you need me, whether that's to look at a quote that you got from somebody else, whether you want to just get your own quote, whatever it is, I'm here for you. Call, text me, email me if you want to buy or refi. And we'll talk more about the oil trade next week. Have a safe weekend. Don't buy into the fear, okay? It is a scary time. There's no question about it. There's no question about it. But don't buy into the fear hype that's coming. Don't make any decisions based on that. Relax. Take a look at things. Meet with your financial advisor if you need to. Just try to stay the course, because these things that we're seeing right now most likely are temporary. They're not good. Most likely they're temporary. We don't want to make any big decisions based on short-term circumstances. All right. Have a great weekend, team. I'll see y'all soon.